Hello, investors. It's Don Vandenbord, Senior Portfolio Manager with Revere Asset Management. Today is Thursday, March 16th, 5:21 p.m. Eastern Time, coming to you from St. Augustine Beach, Florida, with tonight's Revere Market Insight video. State of the market, a little bit of an upgrade. I've been saying over the last couple of videos that I don't really recall uh, such a bifurcated market where if you looked at four of the indexes, it looked like you were in an absolute bear market, while if you looked at the Nasdaq 100, you thought you were in a rip roaring bull market. So and more of that happened today, although we did get some much needed breadth participation and changing the state of the market from correction to correction with a tech rally, because that's really about the most appropriate way to describe this bifurcated market. If you check over here on the trend gauge, market leadership, leaders had a great day. We're upgrading that, the sub arrow from red to green, still keeping it under neutral. Want to see how we finish the week. Still a lot of moving parts, but there were definitely some good signs for the banking system today. Short term, all five major indexes are below their 21-day moving average. Well, I should say four of the five, as the NASDAQ 100 continues to lead the way. 4 out of 5 below the 50-day moving average, the exception again being the NASDAQ 100 and long term. We've got 3 of the 5 below their 200-day moving average. The S&P, with this rally, managed its first close back above the 200-day moving average, the NASDAQ 100 firmly above. And what a change this has been from December of last year, when everybody wanted to stay away from those big NASDAQ stocks. But what happened today? Gap down, as we had some more fears overnight. Wasn't a huge gap down, but a gap down nonetheless. But we put in the bottom within the first 45 minutes, and then a strong reversal higher as more news trickled out about the US and the Eurozone adding liquidity to the financial systems. Uh, Switzerland said it would back Credit Suisse. Eurozone said they would add whatever liquidity needed. Yellen came out, said the same thing. The Fed is making the discount window available, and some of the regional banks still under pressure, but late in the day, a consortium of big banks uh, came together and said they would make big deposits into one of the teetering uh, banks, and that added just little by little, more and more all throughout the day. Things became more optimistic, and we closed near the highs of the day. Here are the final numbers. The G6, this is our 6 ETF growth composite, up 2% on the day. S&P, after a 0.5% gap down, closed up 1.76%. NASDAQ 100 up 2.64%, Dow up 1.2, midcaps up 1.4, global diversified 60/40 up 1 point, no, Russell 2000 up 1.45, global diversified 60/40 up 0.78%. Bonds lagged today as a little bit of a relief rally in rates, meaning prices came down as people are a little less fearful by the end of the day, but as they were at the beginning of the day, and certainly by the end of day yesterday. So up 0.78% on Global 60/40 in-house GROTECTION. We put a lot of money to work today. Little by little, as the market participated, we ended up on the day up 0.81%. We'll go through the tail of the tape and charts of interest. Let's get that started right now, and we'll start off with what we always start off with, the S&P 500. And let's go right to the 5-minute chart here, and you can see the gap down, a little bit of an early rally, tested the lows, and the lows held. And then this is what kicked off the strong rally. News started hitting the wire about liquidity injections and the banking system vowing not to repeat 2007 to 2009. Very strong rally up until late morning, 39.44. Where did it pause? Right at 39.40. We got above it and then failed quickly. And the initial thought was, when you drop 20 points after going above the 200-day moving average, was that here we go again. It was a false break above. we're going to break down, but we did not break down. Buyers came back in. We took another shot above 39.40. This time at 12:50 p.m., rallied all the way up to 39.61. Great stuff. Now you know you got to backtest that in order to backtest that level in order to have some confidence. So little by little, we started trickling lower, 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 and then here's the break. You can see the candle longer than any candle in that process. We undercut 39.40, got down to 39.37, and immediately buyers came back in. So we got a fake break above the 200-day, came down again, a true break above, testing it back, break below and held, and back above and closed near the highs of the day. So this is critical, this is critical, and this is critical. And right now we need to hold 39.40 going forward. You can see 39.37 back here 2 days ago. That capped that attempted rally before we had two more shaky days, but getting above it, below it, back above it, testing it, and holding, to me, good stuff. And back above the 200-day moving average, just shy of the declining 21-day moving average. That's the green line above the ultra short term 80 MA, and it's hooking higher, so that's good. So what do we want to see next? We would need to get above the 21-day moving average, which is just about flattened out. That's the next level for the bulls. We've come a decent move off the bottom yesterday, but now we're making higher highs and higher lows. And if you look at the 60-minute chart here, here's this 39.50. Let's go down to 39.40-ish, which is basically right where the 200-day moving average is. You can see back here it held, then it held again, then it failed. Then we failed to get back above it. This is a classic support flipping to resistance. And now we're back above 39.37, 39.40. That's the 200-day moving average. Any pullback, we want to hold that level. If we poke below it, we want to get right back above it in very short order. And that's the key takeaway level right now. S&P 500, 39.40. If we in fact have put lows in as part of this financial crisis, and we never say never in the market, but if the financials, they could make a big move off the bottom. Here's the banking indexes, KBE, this is big banks, from 50 still down 37, more than 24-ish percent off of their recent highs. We got a long way for these things to rally back up. KRE in even worse shape, from 65 down to 46. So we get some confidence back in these regional banks and the bigger banks. JP Morgan, for example, bouncing at the 200-day moving average today. If you want another level to watch, today's low on JP Morgan or the 200-day moving average around 125, 126, that should not pierce if this market is going to continue its upward direction. Let's go to the NASDAQ 100 now, and you can see, look how strong this is. 4 days off the bottom, biggest candle of the 4 days, blasting above that reversal high that we made on 3/6 when we started rallying off the 200-day moving average. And undercutting, reclaiming back above the 8, back above the 21, and now we're 3.4% above the 21, getting a little bit extended. Wouldn't be surprised to see the NASDAQ 100 take a little bit of a break. If you look at the 60-minute chart, so much more healthy than what we just looked at the S&P 500, which looks so much better than the Dow, mid caps, and small caps. So we're approaching these highs back from February, back in early February. And in fact, we're showing a flat base here with a 9% depth. And this is where we put a bunch more money to work today, was in the NASDAQ 100 and the QLD. And then later in the day, after we tested and then held that 39.40 area on the S&P 500, we started buying UPRO. So that's where we're concentrating our money. And the reason is there's the risk reward is so low right now. If things roll over and fail, the money that we put into the S&P 500 and the NASDAQ 100 is easily hedged on a break back below 39.40, which is less than a 0.5% away. So if that level gets tested and fails, we'll immediately put hedges on. Until that probably would mean that another negative headline hit the news, hit the market, and we'll see where that headline takes us. But it's such a low risk. 39.40 is such a low risk, positive risk reward area here that we took advantage of it big time today. Let's go to the Dow Jones Industrial Average, and still under the 200-day moving average, but didn't make a lower low today, so that's a good sign. Right into the declining ADMA. Mid caps uh, started out, didn't make a lower low either, still below the 200-day moving average. And small caps, uh, did they make a lower low? 173. Nope, didn't make a lower low either, despite a 1.2% gap down on that. Big move up off of the lows. So these lows of these last of this week hold on the Russell small caps. That's that 170 area, which also corresponds to the December lows. We can mount some sort of a rally here again. Down from 200 all the way down to 176 in just a couple of weeks is a pretty big sell off here, but you can see the stochastic trying to roll over now from deep oversold territory. Let's go to the dollar. UUP today down, traded in a tight range. You can see just really a continuation of yesterday where it's just trending lower. That's good. Money piles into the dollar during economic crises normally, and if it's not, that means that there's not that huge a concern from a global basis. So we're below the 200, above the 21. Did just recently get the hookup in the dollar on the stochastic. Let's go to the VIX. VIX made a 5-day low, so chopping all over the place in a very large range, basically between 23 and 30, but closing near the lows of the day, down 11.3% on the day. And like I said, lows of the day. So you got this 2363 area. We're back to that area below the 200-day moving average. Let's see what happens when it hits. And this doesn't react by bouncing off of moving averages. They're more reference points than anything for the trend. So you don't really use TA on the VIX. You use it more as reference points for what the trend is, and you don't expect, oh, the VIX is coming into the 21-day, it should bounce. There's a lot more at play than that. Let's flip to bonds. Broad bond index BND down on the day, which means rates went higher, which means a little bit of the panic came off uh, as liquidity was injected into the banking system. Junk bonds, junk bonds up on the day, which is good. They should trade like stocks, and stocks were higher. High quality corporate bonds down on the day, just barely down on the day. And TLT, the long term bond, uh, down 0.75% on the day. So we started out higher across the board on all of the bond indexes, just like we started out lower across the board with stocks. But as stocks rallied, bond prices came off, which is significant in that money is moving out of the bond market where it had a panic move into. And into equities. So let's take a look at rates. Here's the 10-year. Undercut, but look at this outside bullish engulfing. That's good stuff. So you can see 3 days, 3 straight days now, 4 straight days now, we've closed near the upper part and leaving long tails on the end of the candle. So things are starting off weak overnight, but as the day progresses, uh, coming off the lows, which means at this point rates are going back higher, prices are going lower, and it's indicative of which way the money's flowing. TYX, the 30-year, didn't undercut, bounced at the 200-day moving average. Finally starting to calm down a little bit. Rates are very oversold, just like they were very overbought a week and a half ago before this whole fiasco started. Let's flip to precious metals. Gold, basically tight on the day. It's holding this higher range. Silver SLV down on the day. This is despite the slightly weaker dollar, and GDX gold stocks also down on the day. Can't get back above the declining 50-day moving average, but holding the 21. So we'll see which one of these moving averages as it pinches, see which one of these wins out. And let's double check Bitcoin before we leave, up 2.4%, consolidating at the highs after the move up 4 days ago. So those are the major indexes that we track. Let's go to the tail of the tape now. Stochastics have improved on S&P 500 and NASDAQ. They're positive. The other three indexes are neutral as they're trying to hook up from oversold. Also, 5 of the 6 G6 are neutral. ARC is the only positive one. NASI RSI, this is a big one. This is flattening out and a chance for a hookup tomorrow. Dollar is under the 21. We want to see that get above the 21, or it's above the 21. We want to see it continue to come off. And then TNX and TYX with that. We talked about the island top. Was this a panic low or out over the last 4 days? We want to see the lows in yields hold over the last 4 days as we lead into the Fed announcement next week. So you can see 5-day low we made on the VIX, fear and greed back into fear from extreme fear. So the news, Swiss government-backed Credit Suisse, Philly Fed was weak, which is indicative of headed towards a recession. There were some employment numbers that came out that weren't beneficial to the Fed either. The ECB hiked 50 basis points to fight inflation, but then injected liquidity along with the Fed and JP Morgan and a bunch of banks, and that really calmed things quite a bit today. Rate hike odds, 20% of no hike, now up to 80% of 25-point basis hike, which means fear again is leaving as this zero, the odds of this lessens and we go toward 25. That's more fear leaving the market. Day count from 1 down to 1 up. We got above the 80 EMA for the first time in 7 days, still below the 21 EMA on the S&P, but very close. Expectations upgraded from negative to neutral since we got above the 200-day moving average. We want to get back above the 21 to make our expectations on the positive column. Got back above resistance on support and the support levels. Sorry, above resistance levels on the S&P and the NASDAQ 100. Here's the key to that action intraday, that cup toward the end of the day where we made the undercut and reversal bottom that tested that 39.40 area, which here's the failed break above. We broke back below it. We got back above it. We tested it and held it. To me, it's big when a big area flips between support and resistance. People laugh at technical analysis, say it's voodoo, but it it, you see too many things that are too consistent across time for it to be voodoo. Um, Sectors today, 11 out of 11 up, but the weak ones were defensive ones, which is a good sign. Real estate and staples. The strength was in communication services and tech, semiconductors, and KBE banks with a nice rebound. We flipped from the start of the day to the end of the day between bond yields and bond prices. Dollar slightly down, solar down, gold, silver, and gold and silver stocks either lagged or were positive by a very small amount. So here's our focus list. We'll take a look at these charts in a minute. In-house, we added all day long to QLD and UPRO as we got above certain levels using stochastics between overbought and oversold. So we increased our exposure basically from 0.27 and tripled it up to 0.73. One sell we did was ANET as it's more than 3 ATR extended above its 21-day moving average, and we got our plus 2R gain on half of it. We still own half of it. Always want our last sell to be a defensive sell, and that's the equivalent of just leaving a runner to squeeze as much out of it as possible. Bottom line, US and Europe add financial system liquidity, S&P 500 regains 200-day moving average. Let's see what fun and games the market has for us overnight and into tomorrow. And now we'll go to tickers. We'll start off with ANET, and you'll see how extended. This is a very clear leader. We want to get more money into this at a much lower risk entry point. Look what this thing has done with volume and from the relative strength standpoint during this pullback. Look at the market pullback here. This is, you've heard me say, leadership is apparent in the pullback. Bouncing at the 21, bouncing at the 21, bouncing off the 21, volume drying up here as it came back, volume coming in here, came in on the move higher. This is probably the strongest stock in the market. We should have more money in it, frankly. But what was going on in the market kept us away from it. But it's very clearly stood up and shouted that it's a leader, but it's also a leader that is more than 3 ATR, almost 4 ATR extended from its 21-day moving average. So odds favor it's going to pull back, a pullback to the ADMA, preferably a gentle one, would give us a greater risk reward to put more money into that name. Palo Alto, we still own this also. That's had a nice move off the 21, not that much volume, slightly below average, but looking good. And then you got the relative strength blue ball also, which is good stuff. TMDX, we own this, undercut and reclaim the 21. SOX L, great day today, up almost 12% off of its moving average. We make our decisions based on the SOX, not on the SOX L. You always use the underlying. SOX L is a derivative of SOX S. So we make our decisions based on the action of SOX off the 21, off the 50-day relative strength line. So good stuff there. Now, onto the charts of things that we don't own. AMD, huge breakout today, big volume. Uh, they've got a new processor out that apparently is a big leap forward. And you can tell by the price and volume action of this that AMD is a breakout from a stage one base, and it's declaring its leadership based on that price and volume action, along with NVIDIA, which absolutely looks great, making a higher high. Anything making a recent higher high over the past couple of weeks is absolutely a leader in the face of declining relative strength. That looks fantastic. ON got an upgrade today, so that reclaims some moving averages with a little bit of volume, not a whole lot. They've got earnings next week, though. Uh, ASO reported earnings. That's Academy Sports. Big breakout, 300% above average volume. Hard pullback during the day, but recovered most of the losses. And that's a breakout, but it's a breakout. It's a third. It's a 1C base, which means it never made the 20% gain uh, after these other two base breakouts. ASO LNTH got an upgrade a couple days ago. Took the right market to get it to break out of the cup and handle. That's looking pretty good. PagerDuty reported earnings. Not the best looking pattern, but 391% volume, up 15%. In a software stock, you got to pay attention to it. And after hours, FedEx, stage one base, and it's breaking out of it. After hours, FedEx trading at 227. So clear breakout above this 217 level of a stage one base after this big gap down two earnings reports ago. Finally, some good stuff from FedEx in the transports, and that's going to wrap it. As always, love to hear from you. You know what we do at Revere, right? We protect the downside, and when the market gets right, we're putting money to work to participate in the uptrend. We want to stay away from the market when it's below the 200-day moving average. That's why we were so happy to see it reclaim that 39.40 level today. Now we need it to keep that 39.40 level on any pullback. Why? Because it's not how much you make in the market, it's how much of that you can keep. If you're interested in learning more about us, email me, don@revereasset.com, or phone 855-REAL-WEALTH. That's 855-732-5932. And with that, I will wrap up Thursday, March 16th. This is Don Vandenbord with Revere Asset, telling it like it is. Thanks for listening and have a great day.